Hey everyone, and welcome back to Money, Mortgage, Moving Out. I'm Sam and this is Pip.
Hi!
And today we're going to be talking about credit scores.
A credit score is a tool used by lenders to work out if you're eligible for a credit card, a mortgage or a loan.
So this means a credit score is a very important part of buying a property. But what you also need to remember is that a high score is better than a low score.
Yeah. So let's get started. There are many things that can affect your credit score positively and negatively.
Your credit score can be affected by your history of credit card payments, how much of your credit account you are using, and your total debts.
It can also be affected by credit searches. This can happen when a credit application is made.
Fortunately, there are ways to manage your score if you aren't already. Things like applying for the electoral roll is a good idea.
You would also have to make sure that you don't miss any payments, such as phone bills and credit card payments.
Another way to manage your score is quite simple. You have to just check regularly on your credit score and report regularly to make sure there's no mistakes onto your account.
You should also close any unused credit accounts, as having a large credit limit can be viewed negatively by lenders.
Martin Lewis, money saving expert, has given us 10 things that we need to focus on when talking about credit scores.
Number 1, there is no such thing as a credit blacklist, and you don't have a uniform credit rating. Some people think once you get rejected by one company, you are then going to be rejected by all the companies, but that is just not true. All companies review and score you differently, and they all remain secret. That being said, if you do have a poor credit score, you may feel like no one wants to take you on. There are some companies set up to help people with a bad credit history, but they do charge high rates for this service.
Number 2, credit scoring is about predicting future behaviour. So when you apply for a product, a credit check is done, and all of your financial information is put through a complicated algorithm, because they want to predict what you're going to do in the future and if you are going to pay them their money back. But this isn't easy if you haven't got a lot of credit history, as the algorithm doesn't have enough information to predict if you will pay back in the future. It will help to build up your credit score before applying. A few ways you can do this is by taking out a car finance deal or a mobile phone contract.
Number 3, when companies check your credit score, it is as much about will you make the lender money as it is about the risk of lending you money. So like any company, they want to make a profit. And even if you have a perfect credit score, you may not add up to the wish list they want for a profitable customer. The most profitable customers are those who are perpetually in debt, never defaulting and always making the minimum repayments. This doesn't mean you should be sloppy with your repayments, because you might end up in a bad place if you do.
Number 4, what lenders really know about you. It's important to know what the lenders can see about you, as then it's easier to make yourself look desirable for that lender. The application form is one of the most important parts, as this is where the lenders can obtain as much information about you. Your salary, your postcode, your family size, whether you're a homeowner, and the reason of the loan. You need to make sure when you are filling out the application form that you are careful and consistent, because fraud scoring companies will filter your application if there are a lot of inconsistencies. The lenders will know about past experiences they've had with you, because they all use previous data that they've got on you when they've had a previous dealing with you. This means people with a limited credit history could probably rely on their own bank if they want to take out a loan. But obviously, people who have had problems with lenders will probably find it more difficult to be accepted. All lenders will use credit reference agencies. These companies compile data and send it to the lender. The data they send over will mainly be about the electoral roll, court records, addresses and linked data, building societies, banks, Utility companies and other organisations also use these facilities to share their information about you.
Number 5, what lenders don't know. A lot of people think that all of their life is on credit reference files. In actuality, it's mainly just a set of financial data. Although over recent years, the information contained on them has grown. Martin Lewis' money-saving expert website has a list of things that aren't included, so if you are unsure, head over there and check it out.
Number 6, your credit report dictates what product you will get and the rate you will get. This does mean that pretty much every credit provider uses your credit file to dictate what kind of interest you will get and whether they'll provide you with credit. The way this manifests itself is through representative rates on loans. Only a minimum of 51% of customers must get the advertised rate. They may be offering a 6% rate, and this is known as a representative APR. But what could happen is you could be accepted and then offered a 40% interest rate, as you have a poor credit score. It does actually apply to other things too, because some 0% credit cards will give you a shorter 0% period if you've got a poor credit history.
Number 7, we don't actually have a right to be lent money. The government pushes people in the world of small businesses and mortgages to offer more credit when they are lending money. But it is still a commercial decision for companies as to whether they decide to lend to you. This is primarily done using a massive system of automated, impersonal credit checks. It is actually cheaper for a company to reject someone that they should be lending to rather than accept someone that they shouldn't be lending to. You might think that this is unjust, but with the world of credit scoring, you are just a number and you just have to understand this.
Number 8. When you apply for a product, they always check if you are a desirable customer, but they also check if you are a legitimate one. Which means, as well as using credit reference agencies, lenders also use an anti-fraud agency to try and see who's legitimate and who's trying to use fraudulent information.
Number 9, credit reference companies will try to sell you a credit score. But it's okay though, you don't need to take this too seriously. Your credit reference agency file is important, but your credit score isn't. What used to happen is credit reference agencies made all their money by selling data to lenders. Then a clever clogs at credit reference agencies realised that they could make money from a business called customer credit management. It meant they could start selling you all sorts of other types of data and monitoring products and make some money.
Number 10. Credit scoring affects far more than you think. Since 2007, when the credit crunch started, the importance of credit scoring to our financial lives has grown quickly. And I just want to give you a quick rundown on how it affects major financial areas. Mortgages. When your credit score is poor, you will more likely be rejected. Credit card. With your credit score, it dictates whether or not you will first be accepted, whether you will be given any promotional rates, and what amount of APR you will be charged afterwards. Loans. Your credit score affects the amount that you will pay and if you will be accepted in the first place. Utility bills. It's important to pay your bills on time, as it may become difficult to apply for other credit.
How to boost your credit rating.
Different lenders want different things, so if you get rejected by one, it doesn't mean you'll be rejected by everyone.
Some people are unattractive to all lenders, and these are the people with very low credit scores.
These are a few tips that make sure lenders can see you in the best possible light.
Check your report annually or before any major application.
Register to vote, otherwise it's a lot harder to get credit. And if you aren't eligible to vote in the UK, you should add proof of residency.
Never miss or be late for any credit repayments.
Don't let your partner or roommate's credit score affect yours.
If you split up, make sure you financially de-link too.
Minimise your credit applications by using a free eligibility calculator.
There is only one way to know if you're going to be accepted, and that is to apply. But that does leave a footprint on your credit file, and too many of these, especially in a short space of time, can look negatively on future applications.
But thankfully, the people at Martin Lewis Money Saving Expert have built a free eligibility calculator.
You actually only need to fill out your details once to find out your chances for all the cards on the cards section. The loan ones are separate, so you'll have to use these separately.
On this calculator, above 70% does mean you have a high likeliness of getting accepted. And above 50% means you've got a reasonable chance to get accepted. Anything below that and you're kind of pushing it.
But be mindful when applying and follow these basic rules to get the best rates.
Check addresses on old accounts.
Always check your credit files after rejection.
Use a credit rebuild card to build a history and restore some past issues.
Time it right.
Don't withdraw cash on credit cards.
Pay your rent on time.
Payday loans can kill applications.
You can ask why you got rejected.
Never pay for a credit repair company.
Use consistent details between applications.
Life change coming? Apply before it happens.
Cancel all unused credit and store cards.
Reduce debts with savings.
Mitigate damage on default report.
If it's an unfair default, fight it.
We hope that you've enjoyed this episode.
If you need any extra information, then please go down to the link below, which will send you to the Martin Lewis Money Saving Expert website.
Having a good credit score is really important when applying for a mortgage.
As we have said, a great way to boost your credit score is by taking out a credit card.
We have made an episode all about credit cards and the different type of credit cards that are on offer.
So head over there and give that video a watch.
Also, don't forget to head over to Instagram and TikTok and have a look at what we're doing over there, and that is at Money Mortgage Moving Out.
We would also love it if you could like this video and subscribe to our channel. It would be much appreciated. But for now, we'll see you next time.
Much love!